Silver did not just fall, it was slammed. On the final trading day of January 2026, silver was hammered from 121 to 95, and gold was ripped from 5,600 to 4,950 almost in a straight line. $26 erased from silver, $650 erased from gold. In a normal market, that kind of collapse would mean one thing: nobody wants the metal. But that is not what is happening here. The price is falling, and the metal is disappearing. That is the story. That is the event. And if you stay with me, you are going to see why this is not a real market anymore. Because when silver really crashes, inventory should show up everywhere. Dealers should be full. Mints should be eager to sell. Premiums should cool off. Supply should loosen. Instead, the exact opposite is happening. Major mints are pulling back. Dealers are struggling to deliver. Purchase limits are spreading. Vaults are draining. The screen is telling you silver is cheaper. The real world is telling you silver is harder to get. One of those signals is false. If you are new here, subscribe right now. This is where we cut through the headline theater and go straight to the pressure points that actually move markets. And when this video is over, tell me in the comments, if the paper price says one thing and the physical market says another, which one do you trust? The chart on your screen or the empty shelf in the real world? Most people talk about silver like there is one market. There is not. There are two. There is the paper market and there is the physical market. The paper market is where futures, options, derivatives, and synthetic exposure trade. That is where massive institutions can dump huge volumes in seconds. That is where silver can be sold with a keystroke. The physical market is the real metal: coins, bars, kilograms, good delivery bars. The actual product that has to be refined, fabricated, shipped, and delivered. The paper market trades promises. The physical market trades ounces. Those two markets are supposed to stay linked. The paper price is supposed to represent the value of real silver in the real world. But right now that connection is breaking down in plain sight. The paper market says silver is 95. The physical market is saying, try buying it, try finding it, try getting size without delays, limits, or insane premiums. Suddenly the question changes. This is no longer what does silver cost. This becomes, can you even get silver at all? And that is where today's crash stops looking like a normal correction and starts looking like a warning. Let's go to Australia first. The Perth Mint is not some random dealer with a shipping problem. It is one of the best-known sovereign mints in the world. Before the smash even finished playing out, it had already paused wholesale orders for a major silver bullion coin because demand had piled up faster than supply could be cleared. Read that carefully. Not weak demand, not excess stock. A backlog. Not discounting. A pause. And not for a weekend, for weeks. That language matters. Backlog means people are lining up faster than product can be filled. Allocation means they are rationing what little they can push through. That is not what strong supply looks like. That is what strain looks like. And remember the timing. This pressure was already there while silver was still trading much higher. So what happened after price got crushed? Did demand vanish? Or did every serious buyer on the planet see a sale and rush the door? That is the part the chart will never tell you. Now move to the United States. The US Mint did not behave like a market enjoying abundant silver. It halted sales, pulled products, and then came back at dramatically higher prices. Think about the meaning of that. The official mint of the United States could not smoothly keep selling silver through the move. Pricing lagged reality. Inventory lagged demand. Even product releases got pushed back. Subscriptions sold through. Availability tightened. If silver were truly unwanted, the biggest mint in America would not be struggling to manage demand. It would be trying to stimulate it. Then you cross to the UK. The Royal Mint, one of the oldest and most established mints on Earth, sees silver products out of stock. Not exotic collector pieces. Basic silver bars. Bread and butter product. The type of inventory that is supposed to be there when a market is functioning normally. Gone. Then India. And this is where the story gets uglier. In India, some dealers were not just running low, they were failing to deliver. Orders taken, payments made, product not fulfilled, cancellations after the fact. That is not inconvenience. That is stress in the real delivery chain. That is the kind of thing that happens when buyers want metal, and the metal is no longer where the system pretended it was. Then Costco. Yes, Costco. A store built around bulk, abundance, and volume. Even there, silver buying limits showed up. Think about how absurd that is. A retailer famous for letting you buy giant quantities of almost anything now has to tell people to slow down on silver. Why? Because when an asset gets dumped on a screen but disappears in the warehouse, smart money understands the difference immediately. So pause right here and ask yourself the obvious question. If silver really collapsed because nobody wanted it, why are the people who actually sell physical metal acting like they are under siege? Because the crash is not happening in the physical market. The crash is happening in paper. Look at China. The Shanghai Futures Exchange data showed a daily draw that should have made global headlines. Tens of tons gone in a single session, not over a month, in one day. And the remaining vault inventory, when you compare it to annual global demand, is tiny. Almost laughably tiny. The sort of number that sounds large until you place it next to a market that consumes more than 1 billion ounces a year. 400 plus metric tons sounds huge to the average person. In a global silver market, it is not huge. It is a thin buffer, a cushion. And when that cushion starts draining at speed, the message is simple. Metal is moving. Not paper, metal. Now add the geopolitical layer. China is not treating silver like some harmless old precious metal that belongs in a display case. It is treating silver like a strategic material. Exports are restricted. Domestic control matters. Once a country decides a metal matters for industrial security or national priority, that metal stops behaving like a casual commodity. It becomes something to hold back, protect, and secure. So what do you have now? The West is smashing price on paper. The East is taking metal off the table. One side is generating synthetic supply with contracts. The other side is removing real supply from vaults. One side is trading claims. The other side is claiming the metal. Which side do you think is revealing the truth? Watch when the worst selling happens. The most aggressive damage keeps showing up during U.S. market hours, when New York is active and the paper machine is fully awake. Red candles, sudden dumps, air pockets. Then the market stabilizes after that selling wave passes. Sometimes it even firms up again when Asia takes over. That is not proof of destiny, but it is a pattern. And patterns tell you who is acting and who is reacting. Here is the blunt version. Western paper markets can create a storm of supply without creating a single new ounce of silver. They can hit bids, flood futures, and terrify retail traders staring at screens. But none of that puts new metal into a mint. None of that fills an empty dealer shelf. None of that replenishes a drained vault. The paper market can scare holders. It cannot refine ore. It cannot mint coins. It cannot ship bars across oceans. Because the system is showing you its weakness in public. It needs paper force to keep the price lower at the exact same time physical conditions are tightening across continents. That is not a sign of strength. That is a sign of strain. A healthy market does not need this much theater to keep the story together. And then we get to lease rates. In a calm market, borrowing silver is cheap. But when lease rates surge, the message changes immediately. Suddenly it costs real money to get your hands on temporary silver. That tells you physical holders are cautious. It tells you scarcity is being priced. It tells you the people who actually control metal are no longer interested in lending it out cheaply, because they understand how difficult replacement could become. When rates jump from sleepy to extreme, that is not a footnote. That is a siren. So stack the evidence together. Mints pausing or repricing, dealers struggling, retail limits appearing, vault inventories draining, lease rates exploding, physical premiums staying elevated, and all of it happening while the screen flashes a brutal sell-off. That is not what a clean market looks like. That is what a market looks like when the pricing mechanism is losing credibility. At that point, you have to say the quiet part out loud. The paper price of silver may still be the official number, but it is becoming less and less reliable as a description of real-world availability. And that has huge consequences. Because if you hold physical silver, what exactly are you supposed to panic about? The people who need real metal are still chasing real metal. The institutions that depend on paper settlement want you focused on the red candle, not on the fact that supply is tightening underneath it. They want weak hands. They want you to look at the drop, forget the shortages, and hand over the thing the rest of the world is trying to secure. If you hold paper exposure, then the question gets much more uncomfortable. What exactly do you own? Do you own silver? Or do you own an instrument linked to silver as long as the chain of promises holds together? Because those are not the same thing. In normal times, people pretend they are the same thing. In stress times, that difference becomes everything. And if you are trying to buy physical silver right now, you are already learning the lesson in real time. Spot says one number. The real invoice says something else. Premiums widen, availability drops, waiting times stretch. The lower paper goes, the more physical demand steps in. And that creates the paradox at the center of this entire event. The smash is making the shortage worse. Read that again. The smash is making the shortage worse. Because lower paper prices are not solving supply pressure. They are inviting more real-world buying. Every synthetic dump becomes a discount sign for buyers who actually want metal, not ticker symbols. So if the goal was to cool the market down, it may be doing the opposite. It may be accelerating the transfer of silver from weak paper hands into strong physical hands. And that is where the bigger structural picture matters. This did not begin this week. This week is not the cause. This week is the exposure. Silver has been running deficits for years. Mine supply has not kept pace with total demand. Industrial use keeps growing. Solar, electronics, electrification, medical applications, advanced manufacturing, and investment demand all lean on the same metal. Year after year, the world has been using more than it pulls out of the ground. For a while, the system can hide that problem with stockpiles, recycling, above-ground inventory, and financial engineering. But none of those are infinite. Think of the market like a reservoir. If more water leaves than enters, the surface can look stable for a while. But underneath, the level is falling. Eventually, the shoreline exposes itself. Eventually, the buffer is gone. Eventually, a hot week reveals what years of hidden drawdown we're building toward. That is where we may be now. Not at the beginning of the stress, at the point where the stress becomes visible. That is why the timing matters too. End of month, end of week. A powerful month behind us, strong gains already on the board. Then suddenly a violent takedown right at the finish line. Why there? Why then? Because that is when emotional damage is maximized. That is when traders are tired, books are being adjusted, and psychology becomes easy to attack. And that is exactly what this looked like. A message, a scare, a forced story. Silver is collapsing, nothing to see, move along. Except the real-world evidence refuses to cooperate with that script. If this were a healthy sell-off, mints would be relaxed. If this were a healthy sell-off, lease rates would not scream. If this were a healthy sell-off, vaults would not be draining into private hands. If this were a healthy sell-off, major buying limits would not be showing up. If this were a healthy sell-off, physical buyers would not be paying well over paper to secure supply. So no, this does not look like normal price discovery. It looks like a growing divorce between financial silver and physical silver. And once that divorce becomes obvious enough, something eventually breaks. Either paper has to reprice higher to reconnect with the real world, or the physical market continues to detach until the paper quote becomes little more than a reference number for people who cannot actually get delivery. That is the fork in the road. And this is why I keep saying this is not just about price, it is about trust. Because markets run on trust before they run on money. Trust that quoted prices mean something. Trust that contracts connect to reality. Trust that a listed price is at least roughly related to availability. Once that trust starts slipping, volatility is not the problem anymore. Credibility is. So what happens next? I think we move deeper into a world where silver has two prices. The paper number everyone talks about, and the real acquisition number paid by people who insist on actual metal. The official quote may keep whipsawing, but physical conditions can continue tightening underneath all of that noise. That means premiums stay firm or rise. Inventory remains inconsistent. Buyers who waited for lower prices discover that lower prices only made the line longer. And history gives you a warning here. We have seen versions of this before. In past squeeze environments, the quoted market and the deliverable market stopped speaking the same language. The public saw one number. People trying to source metal faced another reality. Eventually the gap closed, not because the shortage politely disappeared, but because the price had to move toward the truth. That is the part many people still do not understand. Paper can distort price. It can delay recognition. It can terrify participants. But it cannot manufacture physical silver from nothing. It can create claims far faster than the mining industry can create ounces. And that works only until enough people decide they want the ounces instead of the claims. That is the danger zone. And it is also the opportunity. Right now, there are three kinds of people watching this unfold. The first group sees red on the screen and wants out. The second group is confused. The third group understands the split. They know empty shelves are not bearish. They know a falling quoted price can actually pull real demand forward faster. They know the system is showing stress, not relief. Which group are you in? Because that answer matters more than the candle from today. Let me leave you with the core point as clearly as possible. Silver got dumped, the quote got crushed, the headlines say weakness, but the physical market is acting like a product under siege. Perth tightened, the US Mint tightened, the Royal Mint tightened, India showed delivery stress, Costco imposed limits, Shanghai saw heavy physical drain, lease rates blew out. That is not the fingerprint of healthy abundance. That is the fingerprint of scarcity, hiding underneath price suppression. So when people tell you silver fell and therefore demand must be weak, ask them a simple question. Then why is the metal disappearing? And when they tell you this is just a normal market move, ask them another one. Since when does a normal market crash come with rationing, delays, repricing, and vault drawdowns? Drop your answer in the comments. Do you think paper silver can keep controlling this story? Or do you think physical silver eventually forces the reset? And if you want more deep dive analysis like this without the usual surface level noise, subscribe now, because the next phase of this story could get even wilder. The price fell. The metal vanished. That is not a market. That is a trick. And the people who understand the trick are the ones least likely to be shaken out by it.